Yes, sir.
Okay, thank you. So in our last lecture, we were discussing about the recommendations of Cadbury Committee, and we had also discussed the OECD guidelines related to corporate governance. We had also discussed that as the time changes, as the business environment changes, there are certain changes or amendments which are being made in the rules and regulations related to corporate governance. So now we will be discussing two very important committees which were formed by the government of India to suggest if any changes are required in the existing structure of corporate governance in India. So first committee that we are going to discuss is the Kumar Mangalam Birla Committee. Now here in these committee, one thing which is very common is that all the committees which we are going to discuss are constituted under the leadership of or under the chairmanship of a renowned industrialist or a renowned manager. Either the chairman is industrialist of the country, a reputed industrialist of the country, or the person has enjoyed or has occupied the highest position in one of the most reputed company in India. The reason behind this was very simple, that as we are talking about corporate governance, the person who should head this committee, as well as most of the members of that particular committee, should belong to the corporate world. They should be aware of the rules and regulations of corporate world. Then only the committee will be in a better state to suggest if any suggestions are required or if any changes are required in the existing corporate governance structure of the country. So the first important committee which was constituted was Kumar Mangalam Birla Committee. It was constituted in the year 1999. So in early 1999, Securities and Exchange Board of India set up a committee under Sri Kumar Mangalam Birla to encourage and raise the standards of governance in the organization. So the main objective of constituting this Kumar Mangalam Birla Committee on corporate governance was to raise the standard of governance in the organizations. Standard of governance means that the level of transparency should be increased. The level of impartiality is to be increased. Whatever has been written in the rules of the organization, that is to be implemented as it is on the ground. It should not happen that for someone who is at the highest position in the organization, some of the rules laid down by the organization are compromised. So that was the reason behind setting up this committee, that the government or the SEBI wanted to increase the standard of governance in the organization. Now, first, first formal and comprehensive attempt to evolve code of corporate governance. This is the first committee which was set up in India to set up a formal code to come to a unanimous conclusion that there should be fixed set of rules related to corporate governance which should be followed by all the organization across the country. Second, disclosure of both financial and non-financial data, frequency of financial and non-financial disclosures. Very important. Financial and non-financial disclosures should be made by the organization to all the stakeholders. And the frequency of financial disclosures, whether the disclosure is to be made yearly, half yearly, or quarterly, that is to be decided by this committee. Next one, it recognized three essential elements of corporate governance: shareholders, board of directors, and management. So when the Kumar Mangalam Birla committee studied on the existing structure of corporate governance in the country, they recognized that the three most important elements of the organization or corporate governance are: first, stakeholders. Now, stakeholders, there are two types of stakeholders: the internal stakeholders and the external stakeholders. Internal stakeholders, very simple, the employees who are working in the organization. First, the organization should take every measure to see to it that its internal stakeholders are happy in the organization, are satisfied in the organization. And next, the organization should also take care of the interest of external shareholders, stakeholders. External stakeholders means the stakeholders who are investing in the organization. Their interest is also to be taken care of. Now, how these interests of external shareholders can be taken care of? So, if the organization is following all the rules, if the organization is not making any manipulation in the financial disclosures or non-financial disclosures, if the rules and regulations are very transparent and they are implemented as it is in the organization, then we can expect that the organization is moving in the right direction. When the organization is moving in the right direction, there are more chances that organization will be profitable, not only in the short run, but in the long run also. So if the organization is gaining profit, is earning profit, ultimately the stakeholders, the external stakeholders, that is the shareholders who have invested their money in the organization, they will be also earning money in terms of premium. So these were the main recommendation of the Kumar Mangalam Birla committee. Now in 2002, so in 1919, this Kumar Mangalam Birla was committee was set up. Now in 2002, Naresh Chandra committee was set up. Now this committee's main recommendations were: relationship between the statutory auditor and the company. Then alteration and revision of statutory audit firms and partners, appointment and procedures of auditors and determination of audit fees, autonomy, auditing functions, measures ensuring management and companies fairness and transparency in financial affairs of the company, randomized scrutiny of audited accounts, and ensuring the independence and effectiveness of independent directors. Now, from these points, we can very easily find out that the basic objective of setting up this Naresh Chandra committee was very simple. That this committee has to study the existing financial rules and regulations under corporate governance, and it should give its recommendation that how these existing rules and regulations related to financial disclosures or related to the financial aspect of the organization, how these rules can be changed, amended for better financial control. So this committee, they looked into only the financial aspect of the organization, that how they can improve the financial disclosure or how they can improve transparency in the financial disclosures. That was the main objective. So first recommendation which was given by the Naresh Chandra committee was related to the relationship between statutory auditor and the company. Now, statutory auditor means compulsory auditor. The auditor which is appointed as per law is called as statutory auditor and the company. So the relationship between the external auditor or the statutory auditor and the company should be professional and it should not be personal. If the relationship is personal, then there are chances that there could be manipulations in the financial disclosures. So the first recommendation of Naresh Chandra committee was that the relationship between the statutory auditor or the auditor who is appointed as per law and the company should be professional only. It should not be personal. Now, if it is personal, for example, if a auditor is external auditor is appointed to audit the balance sheets and other financial documents of the company, and that external auditor is a very close friend or close relative or a very known person to the CEO of the company. So they enjoy personal relations with each other. Now, if such thing happens, the chances of transparency in financial disclosures is less. Why? Because here, as they are friends, as they are relatives, as they know each other for a very long period, there are chances that if any manipulations are there in the financial audit or in the financial disclosure, that manipulation may be overlooked by the external auditor also. क्योंकि एक्सटर्नल ऑडिटर सीईओ का रिश्तेदार है या दोस्त है, या ये दोनों एक दूसरे को 10 साल, 20 साल, 25 साल से जानते हैं। जब वो बैलेंस शीट देखता है, उसे पता चलता है कि बैलेंस शीट में कुछ मैनिपुलेशंस हुए, पर क्योंकि वो दोनों बहुत सालों से एक दूसरे को जानते हैं, वो सीईओ को नाराज नहीं करना चाहता, क्योंकि सीईओ इज अ वेरी क्लोज फ्रेंड टू दैट एक्सटर्नल ऑडिटर, एंड ही साइंस द बैलेंस शीट। एक्सटर्नल ऑडिटर ने साइन कर दिया, मतलब बैलेंस शीट इज करेक्ट, बैलेंस शीट इज ऑथेंटिक, देयर आर नो मैनिपुलेशंस इन द बैलेंस शीट। So if such thing happens, then we cannot expect transparency in corporate governance. So the first recommendation was that the relationship should be only professional, not at all personal. If manipulations are done by the company in the financial documents, immediately it should be brought to the notice of board of directors of the company by the external auditor, and strict action should be taken against those who are responsible for that manipulation. This may happen only if the relations between the external auditor and the company is professional and not at all personal. So that was the first recommendation given by the Naresh Chandra committee. Now, the second recommendation was alteration and revision of statutory audit firms or partners. Alteration means changes, revision means that if we are revising. So, alteration and revision of statutory audit firms or partners. The audit of audit firms should also be conducted. Their background should also be checked when they are being appointed as an external audit firm by the organization. If a particular audit firm is previously engaged in such type of malpractices, such firm should not be contacted or appointed for conducting audit in the organization. So that changes, that revision should always be made. Next one, appointment procedures for auditors and determination of audit fees, autonomy for audit functions. Now, appointment procedures for auditors, how the auditors are to be appointed. So the rules and regulations related to the appointment of auditors were laid down by the Naresh Chandra committee report. It also determined the audit fees, that what should be the audit fees. That is also, that was also recommended by the committee, depending upon the structure of the organization or type of the organization. Whether the organization is situated in tier 1 city, tier 2 city, tier 3 city. Whether the organization is a small scale organization, a medium scale organization, or a large scale organization. Whether the organization is a multinational organization. So, depending upon all these aspects, the audit fees was also recommended by the committee, that this should be the audit fee if multinational company is trying to appoint the external auditor. And if the company is situated, say, in Mumbai, the fees may be different. If it is situated in Pune, fees may be different. If it is situated in, say, Nasik or Ahmednagar or Aurangabad, then the fees may vary. And very important thing is autonomy of auditing functions. Autonomy of auditing function. Autonomy means freedom to conduct the audit functions. Autonomy, full freedom, full authority is given to the auditors. Now, internal auditor who are having contract with the organization that they will be conducting the audit for, say, 5 years, for 10 years, or for 3 years or so. But now these internal auditors, as their contract is with the organization, and they will be earning their fees only if their contract is renewed or continued by the organization. So they may not be very strict with the organization in terms of manipulations in the financial documents. But if external auditors are there and there is full freedom given to them, there is no control of the organization on the functioning of these auditors. If any manipulation is there in the financial document, the auditors should be so powerful that they can immediately contact the board of directors and bring it to their notice of that particular manipulation. So that is called as autonomy of auditing function. So full autonomy, full freedom, full authority should be given to the external audit firm, which is appointed as per law. That was one of the recommendation of Naresh Chandra committee. And it should be so powerful that it can directly be in touch with the highest position of the company or organization, that is the board of directors. Immediately, board of directors can be contacted by the external audit firm, and if any financial irregularity is taking place in the organization, that can be brought to the notice of the organization. Now the next one, measures ensuring management and companies fairness and transparency in financial affairs of the company. So what measures the company can take to ensure fairness and transparency in financial affairs of the company? Now here, one of the recommendation given by the Naresh Chandra committee was that the rules and regulations related to financial aspects should be written down by all the organization, and it should be circulated to the employees of the organization. So every employee should be aware of the rules related to financial aspects. Not only they should be aware of the rules related to financial aspect, they should also be made aware of the consequences if they commit any financial irregularity in the organization. अगर कोई भी गलत काम होता है या गलत तरीका अपनाया जाता है फाइनेंशियल डॉक्यूमेंट बनाने के लिए अगर जो रिस्पॉन्सिबल है वो पकड़ा जाता है तो उसके ऊपर क्या स्ट्रिक्ट एक्शन हो सकता है, ये भी एम्प्लॉइज को एडवांस में बताना बहुत जरूरी है हर ऑर्गेनाइजेशन. Not only the rules and regulations of the organization, but the consequences of breaking these rules and regulations should also brought to the notice of the employees of the organization. That was an important suggestion given by the committee. Next one, randomized scrutiny of audited accounts. It is very simple. Randomly, the external audit firm can scrutinize the documents, financial documents of the company. The audit report, which is prepared by the organization, when it is shared with the external audit firm, and when the audit firm is checking all the details of the audit made by the finance department of the organization, at that time they can ask for any document, any file, or any evidence or proof from the accounts department randomly, because it is not possible to check each and every detail minutely how the financial statements are prepared by the organization. But yes, while checking the financial statements, they are they should be given such power that they can ask for any supporting documents, and they can ask for the evidences of that supporting document also, that this much of amount the company has incurred on giving incentives to the employees. अगर ऐसा कॉलम लिखा हुआ है या ऐसा लिखा हुआ है एक लाइन, तो यहां पर एक्सटर्नल ऑडिटर हर वो चीज मांग सकते हैं जो उन्हें लगता है कि इस पॉइंट से रिलेटेड है. जैसे कि लिस्ट ऑफ द एम्प्लॉइज हु वर गिवन द इंसेंटिव, how much incentives has been given, how the incentive was calculated, why these employees were selected to be given incentives, what was their performance record, are they close to the highest position of the organization. So all these things, whatever they feel that this is related to this particular point, they can ask for, and it is mandatory, it is compulsory, it is obligatory on the part of the organization to produce those supporting documents and evidences which are being asked by the external auditor. And the next major recommendation is related to ensuring the independence and effectiveness of independent directors. When we will be discussing about the types of directors, there we will be discussing the role of independent directors also. Independent director, in simple words, independent, if we know the meaning of independent, rest is very simple. Director is a authority who is appointed at the board level. Normally we hear this term board of directors. What is board of directors? Board of directors is considered as the topmost body in an organization which is responsible for for finalizing or for formulating the most important decisions or policy related decisions for the organization. Now, in that particular board, there are certain directors who are called as independent directors. Why they are called independent directors? Because they do not belong to the family which is controlling that organization. Suppose there is an organization which is owned by Mr. Mahesh. Now, Mahesh is the owner of this organization. As he is the owner of this organization, his son is there in the board of director. His wife is also included in the board of directors. So, after following the rules and regulations, he has included 2 or 3 family members in the board of directors. Now, here, these family members cannot be called as independent directors. Why? Because they have a direct stake in the holding of the company. Then there are 2, 3 directors who are appointed from the organization. Now, Mr. Mahesh has appointed a managing director, and there is also a person who is appointed as the CEO of the organization. Now, as these 2 people are the highest position of the organization, they are occupying the highest position of the organization, they are again given the space or given the place in the board of directors. So they will be representing the organization. Mr. Mahesh family member, they will be representing their family. Now, both these group of people, that is the family members as well as the organizational representative, they are not called as independent directors because directly they are related to the organization. Now, independent directors are such directors who are not having any direct stake in the organization. Now, these directors are called as independent directors. They are expert directors, and these directors should be given power so that they can work effectively in the organization. Now, if directors are given power, then only we can expect that they will be able to work effectively. Otherwise, if suppose if only for the sake of appointment or only to fill the gap as per the rules and regulations of the company, if these appointments are made, then they will not be able to function effectively. Earlier to this Naresh Chandra report committee, the role of independent directors was very much limited. But this committee suggested that if we want to improve the transparency level in the corporate governance, then One of the most important part is that independent directors should be given more authority and more power. Earlier, their voting rights were very less. The number of independent directors to be appointed in the board of directors in an organization again was very less. But Naresh Chandra committee recommended for more powers and more authority to be given to the independent directors. So here now, independent directors who are not having direct stake in the organization, they are so powerful now that they can vote against the recommendations of the board of directors. That suppose CEO of the organization or the chairman, board chairman wants to pass a resolution in the interest of the company. If the independent director thinks that it is against the interest of all the stakeholders or some of the stakeholders, then now, after the recommendation of Naresh Chandra committee, now the independent directors can block or can overrule that resolution also. So this is how the recommendations of Naresh Chandra committee related to the financial regularity and irregularity is considered as one of the most important recommendations in terms of transparency in corporate governance. Now we will stop here. The remaining two committees, one committee is JJ Irani and the other committee is the Narayan Murthy committee. So these two committees we will be discussing in our next session. So please come prepared for JJ Irani committee on corporate governance and the Narayan Murthy committee corporate governance. We will discuss that in the next session. So thank you everyone for
Yes, sir.
being
Thank
present
you.
in today's session. Thank you.
Thank you, sir.
Thank you.